Hi, everyone. For those who just logged on, my name is Dominique, and I have the rest of the Greenleaf team here with us today. And today we will be doing an overview / introduction of industrial, as well as a new deal offering for Kennesaw Flex. But first and foremost, Greenleaf hosts weekly live streams and private connect events with a new topic every week, highlighting a portion of our business. Private events are more interactive, while live streams are open to the public. So before we dive in here, I have some rules of engagement on the screen for you. First, you do have the option to change your presentation view. Feel free to switch your attendee presentation mode to speaker spotlight view, or you can click and drag to make the presentation or the video bigger or smaller. There will be a Q&A portion at the very end of this live stream, so we ask for you to use that Q&A feature located at the bottom of your screen, and we'll use that to facilitate the conversation. This is a friendly reminder that you do not need to wait till the very end. You can submit your questions at any point throughout the presentation. And then lastly, this live stream is recorded and will be shared by the end of the week this week. So before we dive in here, folks, we went over that rules of engagement. We will be doing a brief introduction of what the industrial asset looks like and how we will implement it throughout our business. We'll dive into the Kennesaw Flex opportunity, and again, that question and answer portion at the very end of this broadcast. So without further ado, I will pass it over to Dave and Avi.
All right, thank you very much, Dominique. We're excited to be here with you folks. Avi joined us a couple months ago now, 5-6 months ago, and has been really digging into this industrial component that we're adding into our portfolio. We've spoken some on the industrial stuff, but as we go over just our overall investment strategy, part of it is, okay, maybe we have multiple asset classes, but another part of it is that they're all very similar in our execution strategy. So we're always eager to, we're basically looking for buildings when you look at them, you're like, man, what the heck? What are we going to do there? Those are the buildings that we like. So buildings that have physical improvement opportunities, that could be in, we've done a lot of multifamily, it could be in industrial as well, where we have what can we do to fix up an asset, operational improvements. This goes into everything from how does our team actively manage a property to make it functionally work better. We have an excellent team. We have been together for quite a few years now and work really well together. So we're able to execute on deals that might be a challenge for other organizations. And by doing so, we can add value just in how we operate. And the last part is financial improvement. With a better looking asset, a better physical condition, operating well, we can get better debt, we can get a better exit cap rate. All those things tie into it. We have better financial reporting. Now, when we add all three of these things together, that's what really makes a deal perfect. If we can do all three of these, that's basically getting in a situation the deal is the best that we can make it. So I'm going to talk with Avi here. We're going to go through what do we see in our industrial deals that we're looking for that touch on all three of these points.
Sure. Yeah, so industrial real estate covers a broad group of properties like warehouses, cold storage facilities, heavy manufacturing, light manufacturing, flex spaces, and probably more. And overall demand for this kind of asset class has skyrocketed in the last few years, as you know, because of the e-commerce boom. Dave probably knows this data, but in 2021, e-commerce sales is projected to be around 19% of the total US retail sales, compared to 11% in 2019. So this demand will only increase as e-commerce continue taking larger market share in the coming years. Aware of this trend, Greenleaf, we wanted to get into the asset class, but we starting with flex industrial. And those of you who do not know what exactly it is, it's just a flexible hybrid space with a little bit of office and a lot of warehouse. And it allows tenants to do all kinds of stuff. The tenant pool is so diverse, it's amazing. So why flex? I can list out a few things here. One, in the last few years, it has outperformed all other industrial properties on both rent NOI growth and also demand growth. And we expect that to continue. Second, the demand is, again, off the roof here. One, because businesses pivoting to this omni-channel distribution model. And the second thing is, these big companies, Amazon, Target, Walmart, they're buying up all these big warehouses because they can afford and they want to do their own storage and distribution. But there are other companies who cannot afford or don't want to do their own distribution. They are engaging these third-party logistic companies that are called 3PLs, and these companies are buying everything that's left. So our tenant pool, small businesses, they don't have a lot of availability. They're, all they can find is these flex spaces with small warehouses and small office that they can run the business with. So demand is insane. And then there's lack of supply because of zoning limitations in these infill areas that we look for, and then construction cost is also significantly higher than the last few years. Finally, tenant retention is significantly higher for this kind of subtype because they cannot find right now any space like this. And when they are in your space, they don't move because they don't have to upgrade their space unless there's a business need. And when they do, they'll stay and ask for more space in the same building. So all of this makes us very bullish on this space for the next few years. And day in and day out, when I'm looking for this space, I specifically look for B and C class, 50% occupied properties with market rents below market, certain ceiling height, 12 feet and above, with a little bit of office, or if it's 100% office, is there a chance to convert it to a flex with drive-in and dock high doors and in good locations. So you'll see the deal we're going to talk about next is exactly what I just described. It's in a good location in Kennesaw, single story, big exterior with drive-in, dock high doors, with 30,000 square foot almost space. We're paying $2.35 million, $81 per square foot. It's 64% occupied in a sub-market that's 95% occupied. The building right now is collecting, I think, $6.40 in rent, and it should be around $10, $11. So
But the market is 10 to 11 right now.
yeah, exactly.
Right?
But
Like
we're
when
not
those
saying
signed,
yeah,
right? When those leases were signed, they were good, but that was a
Yeah.
couple years ago now, and now the market's
significantly different. Yeah,
because of all the factors you just mentioned.
exactly. Yeah. So yeah, they were doing fine 2 years ago, but now the shift is so significant. Almost all buildings we look at have that value add in the leases. So the simple plan for the property is to just bring existing tenants to market and lease out a vacant unit to capture that 40% rent differential.
Yeah, and you can see here, we use this consistent as we're looking across all of our deals. And a lot of times we'll have triple net deals. We're like, hey, we have a weighted lease term of 10 years. And in some situations, that's what we're looking for. In this situation here, though, we have our tenants that are all month to month, right?
Yeah.
But they're below market rent pretty significantly.
Yep, 40%.
So if we were looking at a deal that was below market rent significantly, but had really long leases, then our value add proposition will be much more challenging.
Yeah.
So when we say, hey, Kennesaw is a great location, one thing we talk about on location specifically for this flexible space industrial is that it's in an infill area where everything around it is already built. You couldn't go, tear down a bunch of buildings and build a big warehouse. It's just not economically feasible right now. So most of those projects are all further outside of the city. They're taking a big greenfield area, leveling it, putting up a huge warehouse. Here, these locations, this is right off the highway. So we look at this map here, all the other green leafs, these are deals that we've either done in the past or currently own. And this one, if you're looking at it, it's right on the northwest side of Atlanta, so the Kennesaw market.
Yeah, I mean, we love Kennesaw, very strong fundamentals, growing young, educated population, high household income and high home values. And if you're looking at the map, Kennesaw is sandwiched between, highly dense cities, Marietta, Smyrna to your south, Ackworth, Woodstock to your north, and all of these are connected with I-75. So the property.
In I-75 is a road that goes up towards
Chattanooga. Yeah.
So we like 75 going up, and then going the other direction is 85. You see all the other leaves are on the, other 85 side that's going up towards Charlotte.
Yeah, exactly. And so the property being in city limits of Kennesaw is well positioned to capture demand from businesses looking for warehouse spaces to serve those densely populated areas to north and south.
So thinking about, when we look at the deal and we look at two things we're always going to look at, like we're going to look at how does this compare on price per square foot, or are we paying a good price? And then how do the rents compare on the price we're paying? Those are the two factors we're always looking at in a deal. So on the sales comparison side, here we got a couple other really close deals that also transacted recently, and our deal's listed at the top there. We got the little meat leaf graphic, but what do you think about these other three deals that traded right in the area?
Yeah, I mean, they are almost similar to what our building is like, similar size, similar build, glass storefront, similar access. All of them have dock high driving doors, amazing parking availability. They're same space.
Yeah, and these are all recent sales, right?
Yeah, if you look at the dates there, these all happened in the last 12 months. And our property is the least expensive, so that gives us comfort. We are buying it for a good basis, which is way below replacement cost.
So we're buying it for roughly 20% below what the market's paying right now.
Yeah.
And a lot of that too is driven by leases that we're going to look at. So we look at our lease comps. Obviously, if the rent is higher, people will pay more for a building, but that's kind of like they're buying that lease. We're still very much looking at the replacement cost, what it costs to rebuild the physical structure that's there and as is. So as we get better leases, the building will become worth more. So these are, these are some recent leases as well that have happened in the area. And some of these were just the properties that were sold too.
Exactly. So this slide probably has the most important data to validate our business plan of increasing our rent from $6.40 to $10. Because the market, that's what market is telling us, you can get it. So if you look at all of these recently transactions within 12 months, a mile or two of the property, they're all getting $10. And again, all of these are very similar to what our property looks like. Same functionality. On top of that, we just got, for our vacant space today, we have a new LOI from a very strong group. They're willing to pay $11. So that validates
that's right in the wheelhouse of what we're looking for. And these types of leases, it says in the notes here, there's a difference between triple net and this modified gross and then full gross structure where, you're basically going from, hey, who pays what? On one far end, we have the tenant pays everything, triple net.
Yeah.
This giant gray area of, hey, let's negotiate who pays the utility bill. Is there a floor on it? Who's paying taxes? All the way on to the far other side of, hey, the landlord pays everything.
Yeah.
So most of these flex deals are in that middle ground of modified spaces.
Yeah.
So that one you see up there that says $7 triple net or 13 triple net or 9 triple net, but you've got a wide gap that things are coming in at, right?
Yeah. Yeah, I mean, $7 triple net and $11 full service is the same thing. So and good that you pointed out that the first lease comp we had for $7, that same property is listed, I think number 5, and now they're asking, it's active listing and they're asking $9. So you'll see, there's, I don't know, 25% Then in-
Well, yeah, so that first one at $7 triple net, it was signed in August of 2020.
Yep.
And then now, same building.
Yep.
Right, now they're asking $9 a square foot for the same space.
Yeah.
Right?
Yeah, so that'll tell you how significantly market has moved in the last 2 years.
Yeah.
Yeah.
All right, so let's dive into just the Kennesaw deal specifically and what the financials of this look like. So here we have some high level information on just kind of what we're paying for the deal, our fee structures, and what the returns are looking like in years 1 and 2.
Yeah, so again, we're paying 2.35 million. We have almost $250,000 in CapEx. We're changing the roof, some SBACs, and doing some light improvements. Our capital stack and the fees are very consistent.
And we have
over
TI
the-
dollars in there.
Yeah, we are gonna fund our tenant improvement allowance with the CapEx as well.
Yeah.
And if you look at on the right, those projections from year 1 to year 5 also kind of quantifies our business plan, because the NOI grows from 165 to 213,000. So that 45,000 NOI growth in 5 years translates into, 800,000 plus minus 800,000 with market cap. So that's where the value is going to come from.
Right, in value. So
Yeah.
as we have higher NOI, even the same cap rate, we're getting higher value.
Exactly.
Right.
And then there's return, it starts with 7% year 1. And then with all of the operational improvement that we have planned, it's going to go to 12% in year 5.
And that's our annual return in year 5, because we're gonna be fully, we plan to be fully occupied prior to year 5, right? Like we're already looking at leasing the asset right now.
Yeah.
But with leases in place, with escalations by year 5, that over 12% total investment return. And that includes principal payment and free cash that's in there.
Yep.
All right, so we're gonna take a look at kind of what key tenants look like and what the building looks like. And you see we got 2 shades of green here. We got the lighter green and the darker green. And these aren't just funky shapes that we decided upon. This is the actual shape of the building.
Yeah.
So that dark green is the vacant space, and this is the actual shape.
Mhm.
If you remember the first pictures we had, they're curved sides of the building, so this matches that. But tell us about the 2 tenants we have here.
Yeah, so the 2 tenants, they're almost month to month. This Atlanta Fragrance, he has been there for 27 years. And he has already expressed an interest to sign a long-term lease at market rent right now. So the other guy also has some renewal options, and we are hoping to bump him up to market as well.
Yeah, so these 2 that are here, like we're gonna, they're very much businesses that fit this flex industrial space. They are, the fragrances, distributing fragrances out of the back of this building, and the machinery, they're making stuff in the back of this while they have a couple offices up front. So they're good fits for this type of space. And now the vacant space, that's where we plan to spend our TI dollars. And we've already mentioned we're already in talks with groups to lease this space, but our goal will be to lease that, get that up to market, and then we have a fully occupied building.
Yeah, just to give you an idea of the demand. So it's been a month that we have been on contract. I have probably seen 4 LOIs from different groups, and numerous, leads and showing. So we probably gonna lease this before we close it. So, but
Yeah, and you might be wondering, like, hey, why don't someone else just sign a lease? Why would they wait for us to do it?
yeah, so good point. And that was the first question I asked with the broker and seller. The seller doesn't want to spend the TI dollar. And
Yeah.
if you're demanding somebody pay market rent, you have to also upgrade your space.
Yeah.
The seller doesn't have reserve, or he didn't plan for this. So for him, it's easy way out. All right, I'm gonna sell it. It needs a new roof. I'm not gonna do anything.
Yeah.
You guys.
Yeah, the owner right now, like, he owns it profitably. So he's got 2 choices, either wait, I'm getting money right now, or do I want to go spend a bunch of money? So a lot of times the keeping and receive money wins out over spending lots of money.
True.
All right, so let's look at our cash flow and returns. This is a pretty common sheet that we use on all of our deals to consistently show what do the investment dollars look like, how is the cash and the profits distributed over that 5-year period, and we're targeting a 5-year hold on all of our models just to show, apples to apples, kind of what does cash flow look like. And at the bottom, we have our exit sensitivity table, and this is showing us what our values would be based on the cap rate that we exit. Obviously, the lower the cap rate, the higher the value is going to be, and the more profits that are in the deal. So you can see here we're investing about $1 million, right, to start with. You can see year 1, 2, 3, 4, the cash available distributions that are coming out, and then in year 5 is when we have a perceived sale. And if we went back to the slide where you were talking about the year 1 and the year 5 values, you mentioned increases in value by about $800,000. And that's when we increase our NOI, we're then able to realize a higher price with a better cap rate because it is occupied, and that's where our value is created. So overall, it's a deal level IRR of just over 15% based on our projections where we're at right now. And we're kind of hovering around this middle ground for fully occupied. I mean, well, fully occupied is really like 95%, not 100%, but occupied building, in place leases, and exiting around a 6.5 cap. So, all right, so that completes our business plan here. That's what we're looking at with Kennesaw Flex. We're going to bring Kat in, and then we are going to open up to any questions that you have on this deal or even our industrial strategy in general.
All right, thank you, Dave and Abby. And everyone, this is your opportunity to ask your questions using that Q&A feature at the bottom of your screen. We do already have some that have come through during our presentation, so let's dive right in. Why would you say the 10,000 square foot space is vacant now in light of the current tenants paying well below market rent?
Yeah, I can take it. We already kind of touched on it. The seller doesn't want to spend any money. And he also wanted to give some flexibility to the new buyers. So we are in a good spot. We have this space that we can do whatever we like, So not because it has any issues. It's very functional space. That's why we have the LOIs right now, right, already.
Okay, how confident are you that we will be able to keep the current tenants when we raise rents to market?
Well, I would say keeping them or not keeping them or depending on that, like with the demand that's in the market, the points that Abu was touching base on at the beginning of the presentation of just the supply constraints that exist and the demand that's here right now. We're confident we can get the market rents that we would like to see. Now, we would love for that to be with existing tenants. Greenleaf in any asset class we're in, retention is a big part of what we're looking for in anything. But at some point, there's so much value on a new renewal or a new tenant that we have to also look that route. So we would be optimistic if we keep both tenants and they're able to renew at higher rates. But if they're also not able to, we feel pretty confident that we can lease at these rates that we're going in at, because we're still renting below what the real market is.
Yeah.
So
one of the tenants, the guy who has been there for 27 years, he already said he's going to sign a 5-year lease at market rent. He knows the supply. He cannot find the same space if he leaves today.
Okay, what renewal lease terms will you offer to the current tenants?
I guess, operation, it's not that clear cut on just like, hey, we're going to offer X and they're going to accept this. It's more, and especially because we don't own it yet and we can't fully go through anything with them, but we're more talking with them about, okay, if we don't have any prospects for the vacant space, what do we want to do with the 2 that are occupied? But if we get a really good LOI, we've already had some interest with this vacant space and we're going to go elites down that route, we'll probably leave the 2 untouched for the time being until we handle that part. So the rate or the route that we go on the lease up with this, and this is similar to a lot of the deals we do, is we're going to try and maximize the current dollar revenues as soon as we can. So we'll focus on doing that, and then we'll also work, next to how do we maximize the lease length in that process. So exact terms, I kind of skirted around that a little bit, but it's going to be in that north of $10 range is what we're going to look to get out of it.
Mhm.
Wonderful. Well, those are all the questions we have today. As always, we want to thank each of you for your participation. Wrapping up, we will pitch this over to Dominique to review our upcoming dates and live stream schedule.
Yes, thank you, Kat, and thank you everybody for joining again. We just discussed Kennesaw Flex. Next week, we do have a heritage sale update for you all, and then we do have a couple of new retail offerings lined up for you. Starting on October 14th, we have a review of the Family Dollar offering. Well, thank you so much for joining us today. And don't forget to check out Greenleaf Connect's YouTube channel for all of our recorded live streams, with this recording being made available by the end of the week this week. This concludes our broadcast. We certainly appreciate you joining us today, and we look forward to having you on our upcoming live streams. Thanks again and enjoy your day.
All right. Thank you very much, everyone. Have a good one.
Thank you.